December 24th, 2025, 9:42 p.m. Eastern Christmas Eve. And silver just did something it has not done in modern market history. Silver surged to $72.42 per ounce, up nearly $4 in a single session, a 5.6% move during what is supposed to be one of the quietest trading weeks of the entire year. At the same time, gold printed a new all-time high at $4,500 per ounce. Let that sink in. Christmas Eve, thin markets, low liquidity, and silver explodes higher. So the question is obvious. Why now? Why this fast? And why does this move feel different from every rally before it? Because this wasn't a trade. It was a forced event. Part 1. The move that shouldn't have happened. A $4 move in silver in one session is rare. A $4 move during Christmas week is almost unheard of. Normally, this is when desks are half-staffed. Risk is tightly controlled. Positions are kept small. Nothing dramatic is supposed to happen. Yet, here we are. $72.42 silver, $4,500 gold. This was not retail buying. This was not FOMO. This was not momentum traders waking up early. This was panic. And panic always has a cause. Part 2. The catalyst. A geopolitical shock. According to the narrative unfolding across institutional desks, the trigger came from geopolitics. A reported U.S. military blockade of Venezuelan oil tankers ordered directly by President Trump. Whether you support the policy or not is irrelevant. Markets care about shock. And this was a shock. Oil risk spikes. Geopolitical uncertainty surges. And suddenly, every risk manager at every major bank is asking the same question. What happens if this escalates? That's when weak positions get exposed. And silver was full of them. Part 3. The super squeeze mechanism. Here's where the story turns. For years, large banks and hedge funds carried massive short exposure in silver, sometimes as hedges, sometimes as spread trades, sometimes as outright directional bets. But always with the same assumption. Liquidity will be there. Volatility will be manageable. They can exit whenever they want. That assumption died on Christmas Eve. As geopolitical risk spiked, risk managers took control. Not traders, not portfolio managers, risk managers. And when risk managers act, they don't negotiate, they liquidate. Short positions were ordered closed, which means sellers suddenly became buyers. And in a thin holiday market, that's how a squeeze is born. Part 4. Why thin liquidity made this violent. This matters more than most people realize. Between Christmas and New Year, markets enter what traders call ghost week. Liquidity dries up, market depth disappears, order books thin out. So when forced buying hits, prices don't move smoothly. They gap. Every buy order pushes price higher than expected. Stops trigger. Algorithms react. Momentum builds. That's how you get a $4 move in a single session. Not because demand suddenly exploded, but because supply vanished. Part 5. Short Squeeze 101. Why it feeds on itself. This is the defining feature of a short squeeze. When prices rise, shorts lose money, margin requirements increase, risk thresholds get breached, which forces more buying. That buying pushes prices higher, which forces more covering, which creates a feedback loop. And once that loop starts, fundamentals take a back seat. All that matters is exit at any price. That's what happened here. Part 6. The gold-silver ratio. Why $72 is not expensive. Now let's talk valuation. Gold at $4,500, silver at $72.42. That puts the gold-silver ratio around 62.1. Historically, that's still elevated. For much of monetary history, the ratio averaged closer to 30.1. Do the math. At a 30.1 ratio with gold at $4,500, silver prices imply $150 per ounce. Not tomorrow, not guaranteed. But structurally, silver is not expensive relative to gold. It's still lagging. Part 7, the physical market lockout. Now here's where things get uncomfortable. As prices surged, reports began circulating that bullion dealers halted sales. Some marked inventory as sold out. Others simply stopped quoting prices. Why? Because they couldn't hedge. If silver gaps higher while markets are closed or liquid, dealers are exposed. So instead of selling metal, they pulled back. That creates a physical lockout, where cash is available, but metal is not. And once that happens, price becomes theoretical. Part 8. Why this is not just a paper event. This isn't just futures traders fighting each other. Behind the scenes, industrial buyers are moving. Manufacturers can't wait. Tesla, First Solar. Electronic suppliers, they don't care about charts, they care about production continuity. And when they sense supply risk, they don't buy futures. They secure physical metal off market. Every ounce locked up this way is an ounce that never returns to public supply. That tightens the noose. Part 9. January is the real danger zone. Now zoom out. We're still in December. January is coming, and January brings new institutional allocations, rebalancing fresh capital, chasing performance. Silver is now the best performing major asset. Fund managers don't want to explain why they missed it. That's the January effect. Add to that Asian markets reopening, add to that industrial demand, and suddenly the squeeze doesn't end, it accelerates. Part 10, historical context. Why this feels different. People will compare this to 1980 or 2011, but this is not the same. Those were driven by speculation, leverage, retail participation. This move is driven by institutional risk management, geopolitical shock, structural supply tightness. In other words, this isn't enthusiasm, it's necessity. Part 11, price targets, scenarios, not promises. Let's slow this down and talk about price the right way. Not forecasts, not certainties, not guarantees, scenarios. Because markets like this don't move on predictions. They move on pressure. They move when flows collide with structure. Near term, $75 to $80. This scenario does not require panic. It does not require a breakdown. It does not require new information. It only requires continuation. If momentum persists, if January inflows arrive as expected, if institutions rebalance toward the strongest performing assets, then silver moving into the mid to high 70s is not aggressive. It's mechanical. Funds chase performance. Algorithms follow trend. Liquidity remains thin. That alone can carry price higher without drama. Medium term, $100 to $150. This scenario requires repricing, not euphoria. It assumes the gold-silver ratio begins to compress, industrial buyers continue securing supply, physical premiums remain elevated, paper settlement, stress grows quietly. At gold levels already near historic extremes, silver does not need to outperform dramatically to reach triple digits. It simply needs to catch up. This is the zone where silver stops being ignored and starts being respected again. Long term, higher still. This scenario is not about charts. It's about trust. If physical shortages persist, if delivery delays increase, if cash settlement becomes more common, then confidence in paper silver erodes. And when confidence breaks, price no longer reflects fair value. It reflects rationing. Shortages do not resolve politely. They do not fade away. They do not balance themselves neatly. They end when price rises high enough to destroy demand. That is not speculation. That is how every commodity shortage in history has ended. Part 12. Risks. Let's be honest. Now let's address the part most people avoid. This will not be smooth. There will be sharp pullbacks, violent intraday reversals, engineered sell-offs designed to scare weak hands. Paper markets do not surrender quietly. They defend credibility. They defend control. They defend narrative. That means volatility. But here's the critical distinction. Volatility is not weakness. Volatility is friction. Volatility is imbalance. Volatility is stress revealing itself. Calm markets are healthy. Violent markets are strained. And strain is increasing. Part 13. What this means for you? This is not a trader's market. It's an exposure market. In moments of structural stress, vehicle matters more than timing. Counterparty risk matters more than entry price. Availability matters more than paper returns. Physical silver removes counterparty risk entirely. Primary miners offer leverage, but with volatility and execution risk. Paper instruments depend on settlement, liquidity, and trust in intermediaries. None of these are right or wrong. They are different tools, and tools should be chosen intentionally. Part 14. The window is closing. Here's the uncomfortable truth. Most people won't notice this shift until it's obvious, until headlines scream, until prices gap overnight, until dealers stop answering phones. By then, the metal will be gone, the spreads will be wide, and the price will already reflect scarcity. That's how asymmetric opportunities work. They whisper first, they move quietly, and then they explode when participation becomes mandatory. Conclusion. The moment has arrived. December 24th, 2025 may be remembered as the moment silver changed character, not because it crossed a number, but because forced buying collided with thin supply. Banks blinked. Risk managers stepped in. Liquidity vanished. The system showed strain. Whether silver consolidates or accelerates next is secondary. What matters is this. Markets under stress do not return quietly to normal. They adjust. They reprice. They move until something breaks. And when physical reality asserts itself, price is no longer a negotiation. It is a verdict. Call to action. If this analysis helped you connect dots others are missing, like the video, share it, subscribe, because this story is unfolding in real time. And when the market finally admits the truth, it won't wait for permission.